Welcome to my channel, your ultimate destination for mastering finance and business management. Whether you're looking to grow your wealth, build your business, or sharpen your skills, we've got you covered with practical tips, expert insights, and actionable strategies. Let's embark on the journey to success together. Accountant explains house versus flat. Which should you buy? Are you ready? Welcome to Spark Finance. Deciding between buying a house or a flat is one of the most significant financial decisions you'll make. From affordability and lifestyle fit to future investment potential, there's no one-size-fits-all answer. In this video, I'll guide you through an accountant's lens, analyzing the financial and practical implications to help you make a decision tailored to your life and goals. Stick around for real-world examples, live scenarios, and a step-by-step checklist to ensure you don't make the wrong choice. What's the difference? Let's start with the basics. A house usually includes both the structure and the land it's built on, offering full ownership. It's often located in suburbs or rural areas. A flat, or apartment, is part of a larger building where you own your unit but share ownership of common areas. Flats are typically found in urban locations. These differences in ownership structures and locations create variations in price, maintenance, and long-term value, upfront costs and affordability. On average, houses require higher upfront costs, including a larger down payment and higher closing fees. For instance, in a suburban area, a house might cost $100,000 with a $40,000 down payment. Meanwhile, a flat in the city might cost $250,000, requiring just $25,000 upfront. However, don't forget to factor in additional costs for houses, such as property taxes and insurance, which are often higher than those for flats. Maintenance and repairs. Houses come with the responsibility for all maintenance: plumbing, roofing, landscaping, you name it. Flats, on the other hand, usually include shared services, like cleaning and repairs, covered by maintenance fees. While predictable, these fees can feel like an extra cost. For example, a flat may charge $300 monthly for upkeep, but a sudden roof repair for a house could cost $10,000 out of pocket. Appreciation and resale value. Historically, houses tend to appreciate more than flats because of their connection to land, which is a finite resource. For instance, a house bought for $300,000 in a growing suburb could double its value over a decade, whereas a flat in the same area might see a 30% increase. But location plays a critical role. A flat in a prime city area could outperform a suburban house in a less popular neighborhood. The key is to research local trends before deciding. Lifestyle fit. Your personal needs and lifestyle are just as important as financial considerations. Houses provide space, privacy, and room for expansion, great for families or those who value outdoor living. Flats are more convenient for busy professionals, offering amenities like gyms, security, and proximity to city centers. Think about your current lifestyle and how it might evolve over the next 5 to 10 years. Rental income potential. If you're considering property as an investment, rental income is a major factor. Houses typically generate high long-term rental income, thanks to their size and adaptability. Flats, especially in urban areas, are ideal for short-term rentals, with steady demand from tourists or professionals. For instance, a house might rent for $3,000 a month, while a flat could earn $2,000. However, location and demand can make all the difference. Tax implications. Both houses and flats offer tax benefits, such as deductions on mortgage interest and property taxes. However, houses may offer additional opportunities for tax deductions, like writing off home office expenses or depreciation on rental portions. Consult a tax expert to fully understand how these benefits apply to your situation. Live case study: Sarah and David. Sarah, a young professional, is eyeing a $250,000 flat in the city, while David, a growing family man, is considering a $400,000 suburban house. We'll calculate their upfront costs, monthly payments, and appreciation potential over 10 years to see which investment aligns with their goals. By comparing their choices, you'll get a clear view of what might work for you. Common pitfalls to avoid. Don't fall into common traps like overestimating rental income, underestimating maintenance costs, or buying without researching future development plans in the area. For instance, buying a flat in a poorly managed building could lead to high fees or declining value. Similarly, a house in a declining suburb might struggle to appreciate. Do your homework? To make the right choice, assess your financial position and goals. Evaluate lifestyle preferences and future plans. Research local markets for appreciation and demand. Remember, there's no one-size-fits-all answer. With the right approach, either option can be a smart financial decision. Watch the full video to get all the insights. Thank you for watching Sapric Your Finance. If you found this video helpful, don't forget to like, share, and subscribe. Hit the bell icon so you never miss our latest insights on finance and business management.